looking at inventories, which are super high and need to get liquidated, and that usually means prices need to get cut. I'm seeing commodity prices coming down. Oil's the last shoe to drop. Obviously, wages tend to be lagging, but everybody's still yelling about inflation. My actual core view is becoming, not 100% there yet, that we go to deflation in 18 months' time, just mathematically. Now, maybe not at core level, but at headline level.
Right.
Where are you on inflation? Have we peaked? What's your whole structural view on this?
Well, I certainly think that we peaked. I hope at 9% plus. That's not an outlandish call. How far and how fast? Look, firstly, inflation. We're all consumed with inflation. It's a lagging indicator, and in fact, one of the components of the Conference Board's index of lagging economic indicators is service sector CPI, which is dominated by what? By rents. And you look, so much of the CPI, Alan Greenspan called it in one of these transcripts going back in 1996. These are very interesting. The transcripts read like a Shakespearean play or a Greek tragedy. And he's having a back and forth with Janet Yellen. And he calls the CPI a flawed statistic, which is why he relied more on market variables. I think you're right. I think what's more important is why is the five-year forwards back down towards 2%? Why are the 10-year break evens at 230? When you look at the 10-year break evens on a core basis, when you consider what food and energy have done, it's below 2%. I always thought, boy, it's interesting. Everybody's talking about Fed credibility. Well, the dollar's been in a bull market. We have a flat to inverted yield curve. We got these break evens have been coming down. Now commodity prices are rolling over. We've had dollar strength. Normally, if the Fed's credibility was under attack, look, it's been under attack from Larry Summers and from Bill Dudley, academia, the media. The Fed has felt a lot of the heat, except from the markets, right? And we would have had the mother of all bear market steepeners and would have had a faltering US dollar if we were turning into Zimbabwe. We just basically, I think you're right on the money. Look, it's been very unfortunate. We've been hit with a series of shocks, supply side shocks that were inflationary. Omicron and the impact on the participation rate. And then we had China shutting down 400 million people in key port cities, affecting global supply chains. And then, of course, the impact on global food and energy from the Russian invasion of the Ukraine, and that just catapulted. Now, before that, inflation was already rising because the economy reopened far faster than anybody thought. And of course, we had these, both under Trump and Biden, these massive stimulus checks. So, yeah, we had a sclerotic, inelastic supply curve bumping against fiscal and monetary stimulus. And here we got the inflation coupled with all the supply bottlenecks. But you know what? That's all in the rearview mirror right now.